So picture this. You're walking down a beautiful tree-lined street in like one of the most desirable neighborhoods in your city.
Right. Prime real estate.
Exactly. And you just look up and see this stunning luxury apartment. Floor-to-ceiling windows, wraparound balcony, the works. It just sold for $3 million.
Wow.
In cash. There's literally no mortgage. There are no frantic calls to a loan officer, no underwriter pulling 30 years of tax returns. Just $3 million and the keys change hands. No questions asked.
And then maybe 6 months later, before the paint is even dry on that place, that exact same luxury apartment is sold again.
Right.
And then a few months after that, it changes hands a third time. And with every single transaction, the money involved looks, well, a little bit cleaner.
It sounds totally like the plot of some cartel thriller, right?
Yeah.
But it is an incredibly mundane, everyday reality.
Yeah, it happens all the time.
Today's deep dive is exploring the hidden mechanics of how massive amounts of illicit money are transformed into just undeniable, legitimate wealth right under our noses.
And we are pulling heavily from a really fascinating breakdown by an analyst named Zach over at a platform called Clear Money.
Right, yeah.
Yeah.
He calls it the real estate trick that cleans dirty money.
Yeah.
Okay, let's unpack this, because what's really fascinating to me isn't the crime itself.
No, not at all.
It's the invisible financial architecture, the
Yeah.
totally legal, established systems that just allow this to happen every day.
Right, because the foundational architecture of this entire system relies on one thing, which is the illusion of normalcy.
The perfect cover.
Exactly. I mean, if you want to hide anomalous behavior, you don't hide it in the shadows. You hide it in a system that is so massive and so chaotic and, inherently volatile that the anomaly just looks like background noise.
So it's basically camouflage by volume.
Yeah, that's a great way to put it. The global real estate market is an absolute behemoth. Millions of properties are changing hands constantly.
Right, people get married, they get new jobs, they downsize.
Like upgrade, yeah. The sheer velocity of those transactions creates this massive data smokescreen.
And regulators and watchdogs just fundamentally struggle to penetrate that smokescreen.
Right, and crucially, real estate pricing is inherently subjective.
Wait, what do you mean by subjective?
Well, if we look at traditional commodities, right, like gold or oil or even everyday items, the market dictates a relatively strict, universally agreed upon price.
Sure, an ounce of gold is an ounce of gold.
Exactly. But a house is worth whatever a specific buyer is willing to pay for it on a given Tuesday.
Oh, that makes sense.
You might overpay by 20% because you are deeply attached to the school district or, because the property has a specific view you want.
Or just because you made a really poor economic calculation.
Yeah, exactly. And nobody blinks an eye.
So Zach from Clear Money used this great analogy. If I walk into a supermarket and try to buy $2 million worth of apples in cash,
you are definitely getting the cops called on you.
Right. I'm either being arrested or committed. The context of a supermarket just does not support that transaction at all. It violates the rules of that specific market.
But if you take that exact same $2 million in cash,
and I walk into a real estate brokerage and point to a penthouse,
you are immediately treated as a highly motivated premium client.
It's wild. The market's natural subjectivity gives you built-in plausible deniability.
And that is the exact vulnerability that illicit capital is actively hunting for. It seeks out these high-value assets with low transparency and flexible pricing.
Because if you have $2 million in unbanked illicit cash, you are sitting on a massive liability.
Oh, it's a huge liability.
Yeah.
You literally cannot introduce that money into the traditional financial system.
Right, because banks are the gatekeepers.
Exactly. Traditional banks function as the primary gatekeepers of the global economy.
Let's dive into that friction between cash and the banking system. Because historically, if you had dirty cash, you just fly it to Switzerland, right?
Right, or the Caribbean. You'd open a numbered account, deposit the physical cash, and the bank would protect your identity.
But you can't really do that anymore.
No, the regulatory landscape changed dramatically over the last few decades. International banking essentially gutted traditional secrecy.
Yeah, with all those know your customer laws.
Exactly. Anti-money laundering protocols, mandatory reporting. If you try to deposit a massive sum of cash into a bank today, you trigger an absolute avalanche of paperwork.
The bank has to file suspicious activity reports, right?
Right, and they demand to know the ultimate beneficial owner of the funds. They want to know the business generating the cash, your tax history, everything. The bank is a brick wall.
So the goal here is to completely bypass the bank. Because when a normal person buys a home, the bank financing the mortgage looks at literally every aspect of their financial life.
Yeah, they scrutinize everything.
But if you do a cash transaction,
Meaning no financing contingency, no loan,
then that gatekeeper is just completely removed from the equation.
you bypass them entirely. And this brings us to what financial experts call the first phase of the wash cycle, which is placement.
Right, getting the money into the system.
The illicit capital has to be placed into the legitimate economy. Now, Zach points out a really important mechanical distinction here. You can't just, lug duffel bags of physical street cash into a title company's office.
Yeah, that would definitely raise some red flags.
It would, because title companies and escrow agents are still subject to certain reporting rules if they handle physical paper currency.
So how does the cash actually cross the threshold into the real estate deal?
Well, the physical cash is typically transformed into a digital format through various intermediary steps before it ever reaches the closing table.
Like front businesses.
Exactly. Cash-intensive front businesses that mix dirty money with legitimate revenue. Or they use underground banking networks that run parallel to the real system.
Oh, wow. So once it's digitized, it's just wired over.
Right. Once it's digital, it is wired to an attorney's trust account or straight into escrow.
And from the perspective of the title company, they are simply receiving a totally normal wire transfer for a cash close.
Exactly. It looks completely standard.
And the second that transaction clears, the stress is gone, the liability is neutralized, the dirty cash is now legally bound to a physical asset, a house.
You trade the dirty money for a completely legal deed.
It's brilliant in a really dark way. The ironies are just avoiding a bank loan is usually seen as a sign of financial prudence. Like, oh, they're so wealthy they paid in cash.
Right, it's a status symbol.
But here, it is precisely the mechanism used to inject illegal money into the system.
Yeah, but there's a catch. Having your name on a public property record that's attached to millions of unexplained dollars isn't exactly a great long-term solution.
Right, because investigators can just look up who owns the house. The money is placed, but it's totally static.
And highly traceable, which is why they need the second step and arguably the most complex phase, which is layering.
Layering. This is where the magic really happens, according to the Clear Money Breakdown.
It is. The objective of layering is to sever the connection between the original dirty money and the new asset.
So the property doesn't just sit there.
No, it is actively traded.
So they sell it to a friend or like a shell company they secretly control.
For a connected person, yeah. And with every subsequent sale, the price is artificially manipulated.
Right. So the $2 million property is sold for $2.5 million and then flipped again for $3 million.
Exactly. We are talking about highly sophisticated accounting illusions.
Because on paper, if anyone pulls the public records, they just see a house going up in value.
They see an asset appreciating in a competitive market, but economically, there is no real growth happening at all.
The transactions are completely circular.
Right. The same core entity is effectively moving capital from its left pocket to its right pocket.
Here's where it gets really interesting to me. I like to think of it like shuffling a deck of marked cards.
Okay, I like that.
Like if you have a marked ace and you move it from the top of the deck to the bottom, I can still track it. The sequence is easy. But if you take that deck and run it through a multi-deck shuffler and hand it off to 5 different dealers and spread the cards across 3 different tables in a casino, I have absolutely no idea where the ace is. I just have to trust whatever card the final dealer flips over.
That's a perfect analogy. And the dealers in the scenario are the corporate entities facilitating the transactions.
The shell companies.
Exactly. To create a truly impenetrable paper trail, the layering phase relies heavily on anonymous shell companies. And, you don't even need to fly to some exotic offshore tax haven to set this up.
Oh, wait, really? You can do it here.
Oh, absolutely. In jurisdictions right here like Delaware, Wyoming, or Nevada, you can legally form an LLC while completely obscuring the identity of the person who actually owns it.
It's wild when you look at how easy that is. You just hire a registered agent for, what, a few $100?
Pretty much. And the agent's name goes on the public documents, not yours.
So if a cop or an investigator subpoenas the state registry, they just find this one registered agent who represents, like, thousands of different entirely unrelated companies.
It's a dead end. And honestly, the architecture gets even more complicated than that. To create maximum friction, they nest these structures.
Nest them. Like Russian dolls.
Exactly. So a Delaware LLC might be wholly owned by a trust in the Cook Islands, which is managed by a holding company in the British Virgin Islands.
Wow. So when that luxury apartment is sold for the third time, the public deed doesn't say John Doe sold to Jane Smith.
No, it says something like Ocean View Holdings LLC sold to Sunrise Properties LLC. The transaction is completely opaque.
And that opacity, combined with the flexible pricing we were talking about, that is the engine of the layering process.
Yes. The subjective nature of real estate allows these anonymous entities to literally fabricate a story for the money.
Right, because Zach mentioned that money with a story is harder to question. So what kind of story do they tell?
Well, you can claim the property underwent substantial renovations.
Even if they didn't touch a thing.
Exactly. Or you can point to broader market trends in that specific zip code. You are generating a legal paper trail that defines the artificial price jump as a legitimate market profit.
That is so frustrating because the regulatory bodies aren't just fighting the anonymity, they're fighting a legally documented narrative of a successful real estate investment.
Right, which brings us to the final critical transformation step in the cycle. Integration.
Integration.
Yeah.
So the money has been placed, it's been layered through all these shell companies and fake sales, and now it has to exit the real estate ecosystem.
And it exits as completely clean capital. The transformation is absolute at this point.
It's no longer cash from nowhere. It is now officially categorized as profit from real estate or capital gains or investment returns.
The irony of this final phase is just profound.
Because the banking system, which was the huge obstacle in step one,
is now eagerly opening its doors to the money. When a title company executes that final wire transfer, sending millions of dollars in quote-unquote profit to the seller's corporate account, the receiving bank does not see illicit cash.
they just see a pristine, fully documented transaction.
Backed by public property records and state-sanctioned companies.
The money effectively comes out holding a receipt from the real estate market.
And sure, the seller has to pay capital gains tax on that recognized profit.
Oh, wait, they actually pay taxes on it.
Oh, absolutely. But in this context, paying the tax isn't a penalty. It is just the cost of doing business.
That's a laundering fee.
Precisely. It's the fee paid to the government to ensure the capital is permanently immunized from any future scrutiny.
Wow. And once that complete integration happens, those funds are circulating in the exact same mainstream economy that you and I interact with every single day.
They can buy publicly traded stocks, fund legitimate business ventures, buy yachts. The capital has total mobility.
So, okay, if the mechanics of this system, placement, layering, and integration, are so well understood by financial analysts like the team at Clear Money, the obvious question is, why on earth do these loopholes still exist?
Right.
I mean, in a lot of places, buyers don't even need to show the full details of where their cash came from. How is that possible?
Well, the system works because there is a massive gap between legislation and enforcement. Having a rule on the books is basically useless if there is no mechanism or honestly no willpower to check the origins of cash in private real estate deals.
Even when the rules do exist, Zach points out they just aren't enforced properly.
Exactly. Money flows where rules are weak, and it hides where systems are complex. For decades, the real estate industry operated with huge exemptions from the reporting requirements that bind normal banks.
But haven't they tried to close those gaps recently?
They have. There are things called geographic targeting orders, or GTOs, issued by the Financial Crimes Enforcement Network.
Right, FinCEN.
Yeah. These GTOs specifically require title companies to identify the actual human beings behind shell companies making all-cash purchases of luxury real estate.
But only in specific places, right, like Miami or Manhattan.
Exactly. And that's the problem. A geographic targeting order is a highly localized tool. If a GTO is active in Miami-Dade County, the dirty money simply migrates to the next county over.
Or they just buy commercial real estate instead of residential, right? Because the order might only cover houses.
Exactly. The capital always seeks out the regulatory blind spots.
Which raises an important and honestly kind of uncomfortable question. Is this a bug in the system or is it a feature?
That is the million-dollar question.
Because if systems shape outcomes, as the source text says, does the lack of enforcement imply that the broader economy actually wants this cash flowing into property?
Well, you have to look at how much transparency the real estate industry actually desires. Full transparency would radically slow down the very lucrative churn of buying and selling.
Right. Think about the commissions.
Exactly. A single high-value transaction generates massive commissions for brokers, huge property tax revenues for local municipalities, and work for contractors, designers, everyone.
There's like a silent systemic complicity happening.
Mm-hmm.
If you required a forensic audit of every single dollar in a cash transaction, it would paralyze the market.
And for a local government that's struggling to fund schools and fill potholes, the property tax revenue from a hyperinflated real estate market is vital. They're economically disincentivized from questioning where the money came from.
It's a massive conflict of interest.
It really is. But beyond just the economics of it, the source points out an equally powerful psychological mechanism at play, the psychology of brick and mortar.
Yeah. The text notes that people inherently trust real estate. It feels safe and it feels legitimate.
Because it's tangible.
Yeah.
You can physically touch it, you can live in it, you can shelter under it.
Right.
Human beings really struggle to associate something as culturally revered as a home with something as nefarious as money laundering.
When money is tied to property, it adopts that same feeling of cleanness, even when the source of the money is completely dirty.
Exactly. The sheer tangibility of the asset sanitizes our perception of it.
It makes me think of someone walking into the lobby of a luxury hotel wearing a perfectly tailored $20,000 suit.
Oh, that's a good comparison.
If they wear that suit, nobody asks to see their ID. They can walk straight to the VIP bar. The suit projects total legitimacy. In this scenario, the property is the tailored suit for the dirty money. It just looks like it belongs.
And that psychological trust is the invisible glue that makes the whole system function. It prevents the kind of widespread societal outrage that might actually force real reform.
Because it just feels normal.
Exactly.
But we need to talk about the collateral damage here, because this isn't just an abstract financial crime. This directly affects you, the listener.
It really does. It's not victimless.
The people laundering money do not care about the true value of the home. They only care about access to the system. And that artificial demand pushes housing prices up for everyone else.
This is the emotional core of the issue. You effectively have two entirely different types of buyers competing in the same market, the value buyer and the access buyer.
Okay, break that down for me. The value buyer is like a normal family.
Right. A traditional value buyer makes rational decisions based on the property itself. They care about the school districts, the commute times, whether the roof needs replacing.
And they are usually on a strict budget.
Exactly. Their capital is finite. Their goal is to get a livable home at a fair price.
But the access buyer?
The access buyer operates in a completely different reality. They literally do not care if the local school is good or if the commute is terrible. Their only goal is transferring an asset quickly to clean their money.
So they are entirely insensitive to price.
Yes. If a property is listed at $1 million, the value buyer will try to negotiate down to protect their savings. The access buyer will just drop $1.2 million in cash, waive all the inspections, and demand to close in 5 days.
How is a normal person supposed to compete with that? You're trying to buy a place to live, playing by normal rules, and you are bidding against an entity with bottomless cash that physically does not care if they overpay.
You can't compete, and that unequal competition destroys local markets. It artificially inflates property values across the board, which drives up property taxes and prices local residents entirely out of their own neighborhoods.
And the visual evidence of this is staggering. The Clear Money Breakdown mentions empty luxury apartments, homes that sit unused, properties flipping too fast.
Just think about the massive luxury skyscrapers in places like Manhattan or Vancouver. If you walk past them at night, a huge percentage of those windows are completely dark.
Lights out. Nobody is home.
Entire floors of premium real estate sit totally vacant. They aren't communities. They are monuments to parked, layered money.
And the downstream effects of that are terrible for the city. If a building is empty, those quote-unquote residents aren't buying coffee at the local cafe. They aren't going to the local grocery store. The neighborhood essentially suffocates.
The architecture projects immense wealth, but the actual street-level economy is completely hollowed out.
Which brings us to the hard truth of the matter. The text concludes with a really vile caveat: systems versus symptoms.
Right. If we connect this to the bigger picture, it's important to remember that not every cash buyer is suspicious.
No, of course not.
And not every expensive home is part of a scheme. There is a lot of legitimate, highly liquid wealth out there.
But the underlying system fundamentally allows for this to happen.
Yes. And as the text says, systems shape outcomes.
So what does this all mean for you listening to this? Getting angry at a single empty apartment building is kind of missing the point, right?
Completely. This is about understanding how money really works. You are usually only seeing the surface. Underneath, there are systems, loopholes, and behaviors that actually govern the true flow of capital.
Money behaves like water. It relentlessly finds the cracks and weak points in regulation.
And if you understand the system, you make better decisions. You stop guessing why your city looks the way it does.
That's incredibly empowering. By understanding this one specific example of real estate, you gain a new lens for viewing all complex financial systems.
Exactly. Knowledge alters your relationship with the economy.
Well, this has been an incredible journey tracking the life of a dirty dollar.
It really has.
From avoiding the bank during the placement phase to jumping through a maze of shell companies and price inflations in the layering phase.
And finally, emerging as pristine, fully legal capital gains in the integration phase.
All hidden behind the completely wholesome facade of a residential home, while subtly driving up prices for everyone else.
It's a stark reality.
I want to quickly acknowledge the mission behind the source material today. Clear Money is doing great work making these hidden financial systems clear and easy to navigate. So if you want to empower yourself and stop guessing about why the world looks the way it does, definitely check out their content.
Absolutely. They break down complex topics really well.
But before we wrap up, I want to leave you with a final provocative thought to chew on. Something that builds on everything we've discussed today, but wasn't explicitly in the source text.
Okay, I'm intrigued.
We've established that a significant percentage of high-end real estate is currently being propped up by this hidden, quote-unquote, access demand, rather than true value demand.
Right. The market relies on that continuous influx of cash.
So what would actually happen to the global housing market, and even our own home values, if every single one of these loopholes was perfectly closed overnight?
Oh, wow.
If anonymous shell companies were banned and all cash transactions had to go through the exact same rigorous underwriting as a traditional mortgage? If all that dirty, price-insensitive money suddenly vanished, would the clean market inadvertently crash?
That is a terrifying question. How much of our legitimate wealth is actually resting on a foundation of layered capital?
Exactly. Just something to think about the next time you see an all-cash offer close in 5 days. Thanks for joining us on this deep dive, and we'll catch you next time.